Hi, I'm Hunter Hutt, Director of Business Development, and today I'm here with SVP Portfolio Manager Andrew Torres. Today we're here to discuss the fixed income landscape and how our alternative investment grade credit mandates can generate alpha in this type of environment. Fixed income has been a challenging topic as many fixed income mandates are negative on the year. Inflation, the withdrawal of stimulus, and the wild swings bond yields have experienced has made it very difficult to grasp where to allocate capital to. That is why we're here to discuss the 3 ways in which our alternative investment grade credit mandates can generate alpha in this type of environment. The first is that we hedge interest rates. Andrew, maybe you can touch on why we do so.
Well, look, this is very central to our investment thesis, and it's the idea that as fixed income yields have gone lower and lower and lower over the last 20 to 30 years, that the amount of return you generate from having an open exposure to interest rates is decreasing, and yet the volatility associated with those returns is potentially increasing. And we've seen that, certainly seen that in 2021. You know, the issues of running a hot inflation environment at the central banks around the world has created tension that's causing bigger swings in fixed income returns, mainly due to macro factors such as interest rates. So what we're really trying to do is remove that component of fixed income volatility and really focus on very specific company opportunities, which is the credit spread. And we think that we can exploit opportunities in the credit spread world to create a higher risk-adjusted return than you'd get from traditional long-duration fixed income.
Thanks, Andrew. The second is that we take advantage of relative value or arbitrage trades. Andrew, maybe you can elaborate on that a little bit.
Yeah, you know, the investment grade corporate universe is extremely diverse and extremely rich in terms of the number of securities out there. You know, you think of a company typically has one stock, one equity price. Even if it trades on different exchanges, there's really only one security. Well, in bond world, there are dozens, if not hundreds of securities, and each of these bonds has different characteristics. It can be different maturities, different currencies, different put or call features, different collateralization, different parts of the capital structure. So there's just a very, very rich environment, and our job is to look at all the different opportunities to invest in a company and decide where the most attractive part of the capital structure or currency or maturity, where we can rotate the portfolio through these different options to either be more aggressive on our outlook for the company or even just to capture some risk arbitrage between 2 different bonds that have very similar characteristics but happen to be trading at a different price at any given time.
Thanks, Andrew. The third is that we are true active managers that consistently rotate the portfolio. Andrew, maybe you can explain that in further detail.
Yeah, you know, I think the things that you want to think about are how we construct the portfolio and how we're different to a traditional asset manager. And the access to tools such as short selling and leverage really give us an opportunity to trade fixed income or invest in fixed income very differently. So a great example is we can actually take a portion of the client money that we receive and invest it in very short-term, very safe investment-grade corporate bonds. And we're really just looking to earn the carry of those bonds, and we can utilize leverage. So we can borrow money from our prime brokers to invest $3, for example, for every dollar of capital that our investors give us. And so we can build up a portfolio of solid and consistent carry yield in the portfolio. And then secondly, we can overlay with that a active trading rotation strategy. So it might be a relative value approach, the way as I just described, or there's the new issue market, which is constantly offering opportunities because these new bonds are coming to market all the time, and they're typically priced at a discount to where secondary bonds trade. And we can overlay a rotation strategy where we buy these new issues and we try to capture that new issue discount, and then we trade out of it and we rotate to the next new issue on an ongoing basis. And that's something that we can do because of our access to leverage, and we can do it as an overlay to the core portfolio. And that's quite different to how a traditional manager approaches it. So it's a real opportunity to take advantage of active management and maximize it in an otherwise difficult environment for fixed income.
Thanks again, Andrew. To wrap this up in a nice bow, the 3 ways in which our portfolio can generate alpha in this type of environment are that we hedge interest rates, that we're able to capitalize on relative value or arbitrage trades, and that we're consistently rotating the portfolio. Being an alternative manager such as ourselves, we have the ability to access tools that a traditional manager just does not. That is why it's perfect having the alternative investment grade credit mandate in a fixed income portfolio heading into what could be a challenging year. If you have any questions, please feel free to reach out to a member of the team. And thank you, and good luck out there.